welcome to episode 102 of Mo Money, the investing economics show for millennials by a millennial, where our goal is to educate, entertain, and increase the financial literacy of a whole new generation. I know it's wintertime, but your boy is bringing the heat. I, of course, am the host of the show, the attractive, the knowledgeable, the charismatic MC Mo. Now let's get to the money. Since the beginning of banks, people have, I'm assuming, always hated banks and bankers. Just going based off history and literature, movies, etc. You never see a story where banks are the good guys, and that sentiment is pretty true in the present day. Ever since the financial crisis of 2007-2008, banks have continued to be a public enemy. From the bailouts, to no executives going to jail, to Jamie Dimon paying himself $30 million a year as the CEO of JP Morgan Chase. It's no wonder why people hate banks, and why plans like Bernie Sanders to break up the big banks is always met with so much fanfare. But there is another world of finance that is larger and more unknown than the big banks that you think are the problem. I mean, JP Morgan's, the Bank of America's, etc., they are still a problem, but there are others. These companies make up and operate what is called shadow banking. Now, I know that has a tinfoil conspiracy sound to it, and no, I'm not going to start talking about how reptilian people run the finance world. They run the whole world. Just kidding. But maybe. Nah, just kidding. Shadow banking is a thing that exists, but it's not as scary or nefarious. Ooh, nefarious. That's a 62-pointer word in Scrabble, bitch. Others just simply call it market-based finance, which consists of non-bank financial intermediaries. But you gotta admit, that's not very fun to say and doesn't sound nearly as cool. And I know the title of the video made you think shadow banking was gonna be some big conspiracy or some big crime, but it's not. I just used that title as clickbait. I'm sorry. In the words of Madonna, we are living in a clickbait world, and I am a clickbait girl. Or boy. So we all have the basic understanding of how a traditional banking system works. A bank opens, you take the money from your paycheck and under your mattress, and you store it safely in the bank. The bank, knowing you're not going to need all that money right now, takes some and lends it out to local businesses and entrepreneurs to spur new growth in the community. The bank charges them 5% interest on the loan. They pay you 1% for storing your money in the bank, and that 4% difference is how they make money. Putting it in just the super simplest, most basic terms. The shadow banking system are financial institutions that engage in bank-like activities but do not take deposits from you, me, and other regular tax-paying folk. Because they don't take standard deposits, they are therefore not regulated like traditional banks. They're really not regulated much at all, and therein lies the problem, and there is the reason why it's called shadow banking, because it's in the shadows, and it's a shadow that's hard to pin down and keep track of and hard to regulate, just like Peter Pan's shadow. This here is a chart designed by shadow banking expert Zoltan Pozar in 2010, right after the financial crisis. The chart depicts what exactly shadow banking is. Are you confused? Is it overwhelming? Are you trying to comprehend what exactly is going on? Now imagine trying to make rules to regulate something that complicated. Imagine trying to follow everything going on and being able to look at just swarms of data in that market and trying to gauge its health. It's impossible. And that's why shadow banking played such a large role in the financial crisis, because not only did those in charge not know where to look, they didn't even have the power to look there. And even if they did have the power, they probably would not have understood what the fuck they were even looking at. It'd be like if my car started smoking and I lifted up the hood and I looked at the engine. I don't know what the fuck's going on in there. I see a bunch of wires and tubes and pipes connected together, and I don't know what any of it means, but apparently there is a problem. Like I said before, the shadow banking system is made up of non-bank financial intermediaries. So this includes institutions we're all familiar with: hedge funds, pension funds, insurance companies, private equity firms, and investment banks, but also some other entities that you may not be familiar with, such as structured investment vehicles, special purpose entities, and money market funds. So there's a lot of players at work in this system. Let us finally get to the reason why this shadow banking system exists. The reason this system exists is because it provides needed liquidity to the financial system, and liquidity is incredibly essential. It greases the wheels of the American, the European, the Chinese financial systems. One of the reasons is since these entities are unregulated, they have more flexibility for risk taking, and therefore those investors who can afford to tap into the system, like pension funds, can find investments that have the higher returns needed in order to meet the demands for their retirees. A A second reason for the shadow banking system is because of the regulations placed on banks. Thanks to regulation, banks are a bit more cautious, but there is still a need for credit for growth. Corporations tap the credit market all the time to fund things both short and long term. This credit can be used to build new factories, hire new workers, expand the company, whatever. So when traditional banks step back from making those types of loan and extending and creating that type of credit, shadow bank entities step in to meet that demand. Before the crisis, 80% of lending was done outside of traditional banks. The shadow banks are also the companies that provide credit cards, Discover, Capital One. They provide home mortgages like Quicken Loans. They provide finance for auto loans like Ally Bank. Toyota and Ford are even part of the shadow banking system because they provide financing for their automobiles. The shadow banking system helps disperse risk. Companies take things like loans on cars, houses, credit cards, and they sell those assets to another company who bundles them all together and sells the pieces of the bundle to an investor looking for good returns. These are called asset-backed securities, and they were one of the bombs that blew the financial system, but not because they're inherently bad, but because they mix them with fraud and leverage. The shadow banking system is also where derivative trading happens. If you saw or read The Big Short, you're familiar with derivatives. Credit default swaps, collateralized debt obligations, synthetic CDOs, interest rate swaps, there's tons, and they do a good job of helping corporations hedge their risks. So there is the good, glossy version of the shadow banking system. It's simply a parallel credit market that evolved due to regulations on traditional banks, causing a strain on credit creation in the financial markets and inhibiting growth. Now, obviously, there are huge risks. Like I said, the shadow banking system played a huge role in the financial crisis. The obvious one was the loans these lenders were making were shit, and then they were selling them to be made into asset-backed securities, which became piles of shit. Then you have the derivatives market, which at the peak was worth hundreds of trillions of dollars in contracts. Basically, the system is very susceptible to any minor shock and any minor risk. And when there is shock, the banks close their doors, afraid of getting hurt, and the credit market freezes up and the economy comes to a grinding halt. And since these banks are not traditional banks and not regulated, they do not have backstops like the Federal Reserve or the FDIC, the Federal Deposit Insurance Corporation. Here's the bottom line. Shadow banking seems like the Wild West, and in a way it is, but it provides an incredibly necessary role in the financial markets and often more efficiently and more inexpensively than traditional banks. It also provides credit to people traditional banks might turn away, which one can see as a good thing or as a bad thing. It's a place where risk-taking and financial innovation can take place, and that should not be discouraged, but what should be discouraged, or rather prevented, is it from spilling over in traditional banks and putting the savings of average Americans at risk. Good things can come from these shadow bank entities, but there will be those who abuse the system, those who leverage themselves too much, and those who lose track of their liabilities and then they implode. Those companies should fail and not be bailed out, but those who survive are more important to our financial system and the continued growth of our country's economy, and that should be encouraged. I hope this shines some light into the shadows for you and you have a better understanding of the banking system and the financial system. I know doing the research opened my eyes up to a lot of things, so I hope you enjoyed watching as much as I enjoyed putting this all together. Thank you so much for watching another episode of Mo Money. You can find new and classic episodes right here on YouTube. For now, don't forget to like, comment, subscribe, share. Follow me on Twitter. Follow me on Instagram. Like me on Facebook. Mo Money signing out.